Types of business organizations. Sole proprietorship. A sole proprietorship is a business owned, managed, and controlled by a single individual. Features. Single ownership. Owned by one person. Unlimited liability. Owner is personally liable for all debts and obligations. Direct control. Full control and quick decision-making authority. Flexibility. Easy to start, operate, or close with minimal legal formalities. No separate legal entity. The business and owner are legally the same person. Limited resources. Depends on personal capital and borrowing capacity. Key legal principle. A sole proprietorship has no separate legal identity from its proprietor and exists merely as a trade name under which business is conducted. Landmark case. Dajaparthi Venkata Satish vs. Pilla Durga Prasad 2025. The Supreme Court clarified that a proprietorship is not a juristic person and cannot sue independently, though it can be sued under Order XXX Rule 10 CPC. The court emphasized that impleting the proprietor is legally sufficient as the concern cannot act independently. Partnership firm. A partnership is an association of two or more persons who agree to carry on business jointly and share profits or losses. Features. Minimum 2 and maximum 50 partners. Agreement-based. Partnership deed defines terms and conditions. Profit and loss sharing. As per agreed ratios. Unlimited liability. Each partner is jointly and severally liable for firms. Debts mutual agency. Each partner can bind the firm through their actions. No separate legal entity. Firm has no independent legal existence. Registration requirement. Unregistered partnership firms cannot enforce contractual rights through courts under Section 69 of the Partnership Act. Landmark case. Seth Lunkaran Sethia vs. Ivan E. John 1977. The Supreme Court held that partners in an unregistered firm cannot file suits to enforce contractual rights until the firm is properly registered, emphasizing the mandatory nature of registration under Section 69. Hindu Undivided Family HUF. A HUF is a business owned by the members of a Hindu undivided family, governed by Hindu law. Features. Membership by birth. Automatic membership for male descendants. Karta. Eldest male member manages business with supreme authority. Coparceners. Members with rights to ancestral property. Limited liability of members, but Karta has unlimited liability. Continuity. Not affected by death of individual members. Tax benefits. Separate tax entity with additional exemptions. Business operations. HUF can conduct business in the family name, and the business is considered a family concern rather than individual enterprise. Limited liability partnership LLP. An LLP combines the flexibility of partnership with limited liability protection of a company. Features. Separate legal entity. Distinct from its partners. Limited liability of partners for firms' obligations. Perpetual succession. Continues despite partner changes. Flexibility in internal management. Partners can decide operational structure. At least 2 partners, no limit on maximum. Regulated under LLP Act, 2008. Specific legislation governs operations. Professional advantage. Designed to help professional firms and small enterprises compete effectively while protecting partners from unlimited liability risks. Cooperative society. A cooperative society is a voluntary association formed for mutual benefit and social welfare of members. Features. Voluntary membership. Open and voluntary association. Democratic control. One member, one vote principle. Service motive, not profit maximization. Limited liability of members. One member, one vote principle. Service motive, not profit maximization. Limited liability of members. Separate legal entity with perpetual succession. Government regulation and audit. Subject to state cooperative laws. Member rights. Members have equal voting rights regardless of their capital contribution, and succession of membership follows specific legal procedures. Section 8 Company. A Section 8 company is formed to promote charitable, educational, or other nonprofit objectives under Section 8 of the Companies Act, 2013. Features. Charitable purpose. E.g. education, art, science, social welfare. No dividend distribution. Profits used for charitable objectives only. Limited liability of members. Separate legal entity with corporate benefits. Tax exemptions and reduced government fees. CSR obligations. Must spend on causes different from their core activities. Compliance. Strict penalties including fines up to 1 crore rupees and imprisonment up to 3 years for contraventions. One-person company OPC. A one-person company allows a single individual to enjoy benefits of incorporation with limited liability. Features. Single shareholder and director. Same person allowed. Separate legal entity. Distinct from the owner. Limited liability. Owner's personal assets protected. Nominee requirement. Must appoint a nominee. Companies Act, 2013 compliance. Full corporate governance. Requirements. Landmark case. Endemol India vs. Innovative Film Academy 2025. The Bombay High Court ruled that OPC owners cannot be held personally liable for company debts unless fraud, personal guarantees, or misuse of corporate structure is proven. This strengthened the limited liability principle for solo entrepreneurs. Private company. A private limited company restricts share transfer and limits membership while providing corporate benefits. Features. Private ownership. Shares not offered to public members. Minimum 2, maximum 200. Restriction on share transfer. Board approval required. Separate legal entity and perpetual succession. Limited liability for shareholders. Less regulatory compliance compared to public companies. Public company. A public company can invite public to subscribe to its shares and list on stock exchanges. Features. Minimum 7 members, no maximum limit. Free transferability of shares. Capital from public. Can issue IPOs and raise public funds. Separate legal entity with full corporate benefits. Higher disclosure requirements and regulatory compliance. Professional management with board governance. Selection factors for business organization. Critical decision factors. 1. Nature of business activity. Manufacturing, trading. Company or LLP preferred. Professional services. LLP or partnership. Small-scale services. Sole proprietorship or OPC. 2. Capital requirements and liability. High capital needs. Public company. Limited liability protection. Company, LLP, OPC. Personal risk tolerance. Sole proprietorship only if comfortable with. Unlimited liability. 3. Compliance and control. Minimal compliance. Sole proprietorship. Shared control. Partnership LLP. Professional management. Private public company. 4. Tax implications. Pass-through taxation. Partnership, LLP corporate tax rates. Companies, tax planning flexibility. HUF for family businesses. Organizational comparison matrix. Form legal entity. Liability members compliance capital. Access. Sole proprietorship no unlimited 1 minimal limited. Partnership no unlimited 2 to 50 moderate. HUF number. CARTA. Unlimited family low limited. LLP yes limited 2 plus moderate. OPC yes limited 1 high limited. Private company yes limited 2 to 200 high good. Public company yes limited 7 plus very high excellent. Cooperative yes limited 10 plus moderate. Section 8 yes limited 2 plus high donations. Strategic recommendations for startups. 1. Solo entrepreneurs. OPC provides corporate benefits with single ownership. 2. Professional services. LLP offers flexibility with limited liability. 3. Family businesses. HUF provides tax advantages for traditional family enterprises. 4. High growth ventures. Private limited for investor funding and future public listing. 5. Social enterprises. Section 8 company for tax-exempt charitable activities. Remember, the choice should align with business goals, risk appetite, funding requirements, and long-term growth plans. Corporate entities. Companies. Regulatory framework. Companies in India are governed primarily by the Companies Act, 2013, administered by the Ministry of Corporate Affairs MCA. The Act provides a comprehensive legal framework for company formation, management, and regulation to ensure transparency, accountability, and good corporate governance. Introduction. A company is a legal entity distinct from its members, with perpetual succession and limited liability. It can own assets, sue or be sued. Its constitution is governed by the Companies Act, 2013. Private company. Defined under Section 268, a private company restricts share transfers, limits members to 200, and prohibits public invitation to shares or debentures. At least 2 members and 2 directors are required. Rules. No public solicitation. Easier compliance. Penalties. Violation of share transfer restrictions may attract penalties under Sections 447 fraud and 450 imprisonment. Landmark case. Solomon vs. Solomon and Company, Limited, 1897. Established the company as a separate legal entity. Public company. Defined under Section 271, a public company can raise capital by offering shares to the public. It requires minimum 7 members and 3 directors. Rules. Subject to stricter disclosure norms and SEBI regulations if listed. Penalties. Non-compliance may attract fines and imprisonment. Under Companies Act and SEBI regulations. Landmark case. Oriental Metal Pressing Works vs. Thakur 1961. Emphasized stricter regulatory supervision for public companies. One-person company OPC. Allowed under Section 262, an OPC is a company with 1 member, enjoying limited liability and separate legal status. Rules. Must appoint a nominee for succession. Section 31C. Penalties. Misuse of OPC status attracts penalties for fraud under Section 447. Landmark case. Endemol India vs. Innovative Film Academy 2025. OPC members protected by limited liability unless fraud is shown. Characteristics of one-person company. Single member ownership, nominee appointment, limited liability, perpetual succession, and simplified compliance. NITI Company. A mutual benefit company promoting savings and lending among members. Governed by NITI Rules, 2014. Rules. Minimum 200 members, net owned funds 10 lakh rupees, deposits. Only from members. Penalties. Non-compliance with NITI rules attracts fines as per Sections 447 and 450. Landmark case. P. K. Vasudevan Nair vs. Union of India 1990. Confirmed NIDIs are not banks and are restricted in operations. Characteristics of NIDI. Accepts deposits from members, limited lending powers, name must include NIDI Limited, operates on mutual benefit principles. Section 8 Company. Non-profit companies formed for charitable, educational, or social purposes under Section 8. Rules. Requires central government approval, no dividend distribution. Penalties. Misuse or diversion of income can lead to cancellation of license and penal consequences. Landmark case. ICAIV. Union of India 2011. Section 8 Companies performing public functions treated as public authorities. Characteristics of Section 8 Company. Limited liability, charitable objectives, restricted income use, government regulatory oversight. Producer company. Companies formed by primary producers, farmers, artisans under Part IXA. Object. Production, harvesting, marketing of members' goods. Penalties. Failure to comply leads to fines and regulation under Companies Act. Landmark case. Vasavi Red Chilies Producer Company. Limited vs. Rock 2018. Confirmed hybrid nature combining cooperatives and companies. Foreign company. Defined under Section 242, any company incorporated outside India but with a place of business in India. Rules. Must register with ROC within 30 days. Penalties. Penalties under Sections 392 and 393 for failure to comply. Landmark case. Technips v. SMS Holding 2005. Enforced Indian law jurisdiction over foreign companies conducting business in India. Drafting of incorporation documents. Includes Memorandum of Association MOA and Articles of Association AOA. Memorandum of Association MOA. Defines company's name, objectives, registered office, liability, capital, and subscribers. Rules. Ultra vires acts beyond MOA are void. Landmark case. Ashbury Railway Carriage vs. Riche 1875. Doctrine of ultra vires. Forms of MOA. Prescribed under Schedule 1 differ for companies limited by shares, guarantee, or unlimited. Contents of MOA. Name clause, registered office, objects clause, liability clause, capital clause, subscription clause. Provisions in MOA or articles are void. Any clause inconsistent with Companies Act is void ab initio. Landmark case. Messer Holdings vs. Ruia 2019. Corporate documents cannot override statutory provisions. Articles of Association AOA. Internal rules for management, director powers, member rights. Landmark case. Hickman vs. Romney Marsh 1915. Established that members are contractually bound by AOA. Entrenchment provisions. AOA can contain clauses that make amendment more difficult than ordinary resolutions to stabilize important provisions. Contents of AOA. Includes management procedures, share transfer rules, voting rights, dividend policy. Drafting of AOA. Must comply with law and be consistent with MOA. Landmark case. Ely vs. Positive Government Life Assurance 1876. AOA binds only company and members. Formation and registration, stepwise filing of incorporation documents on Spice Plus portal, payment of fees, and ROC scrutiny. Precautions for professionals. Verify identity proofs, check compliance, ensure object clauses align with law, avoid ultra vires clauses. Process of incorporation of public company. Minimum 7 members, 3 directors, submission of MOA, AOA, DIN and DSC for directors, and Spice Plus form filing. Steps for incorporation of public company. 1. Obtain DSC and DIN 2. Reserve name 3. Submit incorporation forms and documents 4. Pay fees 5. Certificate of incorporation issued. Process of incorporation of OPC. Same as private company but single member with nominee. Nominee consent in Form INC 3. Simplified compliance. Process of incorporation of NIDI. Filing under NIDI rules with ROC. Must meet member and net fund requirements within 1 year. Minimum members and net owned funds public company. 7 members, private. 2 members, NIDI. 200 members and 10 lakh rupees net owned funds required. Return of statutory compliances by NIDI. Filing forms NDH1 and NDH3. Deposits and loans must conform to prescribed ratios. General restrictions or prohibitions. Companies must act within MOA objects, avoid illegal deposits, and not misuse funds. Penalties include fines and imprisonment under Sections 447, 450. Process of incorporation of Section 8 company. Requires central government approval via Form INC 12. Declaration of nonprofit objectives and income use. Application for incorporation. Must attach MOA, AOA, estimated income use statement, directors' declarations, licensing fee. Certificate of incorporation. Issued by ROC is conclusive proof of company's legal existence under Section 7(2). Enables opening bank accounts, entering contracts, and operating legally. Limited Liability Partnership. 1. Introduction. Limited Liability Partnership LLP is a hybrid business structure. combining the benefits of a partnership operational flexibility and a company limited liability. It is a separate legal entity from its partners and can own property, enter into contracts, and sue or be sued in its own name. LLP is governed by the Limited Liability Partnership Act, 2008 and the Limited Liability Partnership Rules, 2009. Checkmark Y LLP. Flexibility of partnership, limited liability like a company, lesser compliance compared to companies. Scroll 2. Salient features of LLP. Separate legal entity. LLP is distinct from its partners. Limited liability. Partners' liability is limited to their agreed contribution. Perpetual succession. Not affected by change in partners. Minimum 2 partners, no maximum limit. At least 2 designated partners, one must be a resident of India. LLP agreement defines the mutual rights and duties. No requirement of minimum capital. Less compliance burden than companies. Landmark case. Right finger re. Limited Liability Partnerships Act, 2008 Delhi HC, 2009. Clarified that LLPs are not subject to Companies Act, 2013 provisions unless expressly provided. Scroll 3. Important definitions Section 2. Term meaning. Body corporate includes LLP registered in India or abroad, company, foreign company, but excludes cooperative society. Business includes every trade, profession, service and occupation. Designated partner. Partner designated as such and responsible for compliance. Minimum 2, 1 resident in India. Entity includes LLP, body corporate. Financial year the 1st of April to the 31st of March. For LLP incorporated after 30th September, FY can end on next the 31st of March. Foreign LLP formed and registered outside India. Limited liability partnership a partnership formed and registered under the Act. LLP agreement written agreement between partners LLP and partners. Partner any person who becomes partner per LLP agreement. Small LLP, as per Limited Liability Partnership Amendment Act, 2021. Contribution is less than or equal to 25 lakh rupees and turnover is less than or equal to 40 lakh rupees. Scroll 4. Nature of LLP. Body corporate S. 3. Incorporated form of business entity. Separate legal entity. Assets belong to LLP, not partners. Perpetual succession. Change in partners does not affect existence. Capacity to contract and hold property. Checkmark exam tip. Contrast LLP with partnership under Indian Partnership Act, 1932. Scroll 5. Partners and designated partners. Minimum. 2 partners Section 6. Designated partners. At least 2, 1 must be resident in India. Liabilities of designated partners. O. Compliance with the Act, filing of returns, statements. O. Liable for penalties in case of contravention. Change in designated partners S. 7. O. Intimation to registrar in prescribed form. OLLP must always have at least 2 designated partners. Scroll 6. Incorporation of LLP. Section 11. 21 Deal with incorporation. Steps. 1. Reservation of name. 2. Filing of incorporation documents with registrar. 3. Issuance of certificate of incorporation. 4. LLP agreement to be filed within 30 days. Registered office S. 13. Must have a registered office in India. Effective registration S. 14. OLLP becomes body corporate. O. Legal personality distinct from partners. O. Perpetual succession. O. Power to sue and be sued. Checkmark landmark case. Right finger CITV. DLF Commercial Developers Limited. Delhi HC. Clarified tax treatment of LLP and effective conversion from company to LLP. Scroll 7. Partners and their relations. Eligibility. Any individual or body corporate capable of contracting. Relationship. Governed by LLP agreement or, if absent, by first. Schedule of the Act. Cessation of partner S. 24. O. By agreement or notice. O. On death, insolvency, or mental incapacity. Registration of change S. 25. OLLP must file notice with registrar within 30 days of change. Scroll 8. Liability. Partner is agent S. 26. O. Every partner is agent of LLP but not of other partners. O. Partners Act binds LLP if done in ordinary course of business. Extent of liability S. 27. OLLP liable for wrongful acts of partners if done in course of business. Unlimited liability S. 30. O. In case of fraud, liability of LLP and partner becomes unlimited. Whistleblowing S. 31. O. Protection to partners' employees who provide information about fraudulent acts. Checkmark landmark case. Right finger Union of India vs. DLF Limited. Highlighted LLP's liability is separate from partners. Scroll 9. Contributions. Form S. 32. O. May be intangible, movable, immovable property. Money or services. Obligation S. 33. O. Partner's obligation to contribute as per LLP agreement. Scroll 10. Financial disclosures. Maintenance of books S. 34. O. Maintain books of account on cash or accrual basis. O. Preserve for 8 years. O. Annual statement of accounts and solvency within 6 months of FY end. Audit. O. Mandatory if contribution greater than 25 lakh rupees or turnover greater than 40 lakh rupees. O. Otherwise, audit not compulsory. Annual return S. 35. O. To be filed with registrar within 60 days of closure of FY. Checkmark landmark case. Right finger registrar of companies vs. Golden Tobacco LLP. Failure to file returns attracts penalty. Scroll 11. Compounding of offenses. Certain offenses under the Act can be compounded by the regional director or other prescribed authority. Fine can be imposed but no imprisonment for compoundable offenses. Scroll summary table. Key sections for quick revision. Topic section. No's. Key points. Incorporation 11. 21 Registration, Effect, LLP Agreement. Partners and Relations 22. 25 Eligibility, Rights, Duties, Cessation. Liability 26. 31 Partner as Agent, Extent, Fraud, Whistleblowing. Contribution 32. 33 Form, Obligation. Financial Disclosures 34. 35 Books of Account, Audit, Annual Return. Compounding of Offenses 39 Regional Director compounding certain offenses. Scroll exam tips and strategy. Case law names and sections are crucial. Even brief reference. Fetches marks. Compare LLP with traditional partnership and company. Highlight advantages and compliance differences. For problem questions, apply S. 26. 30 carefully to determine liability. For theory questions, right definition right pointing arrow section right pointing arrow explanation right pointing arrow. Case law right pointing arrow conclusion. Scroll landmark case law quick recap. Case name principle established. Re. Limited Liability Partnerships Act, 2008. LLP is separate legal entity. Companies Act not applicable unless expressly provided. CITV, DLF Commercial Developers Limited. LLP conversion and tax implications clarified. Union of India vs. DLF Limited. Liability of LLP and partners is distinct. Partners' personal assets protected. Registrar of Companies vs. Golden Tobacco LLP. Non-compliance of filing obligations attracts penalties under LLP Act. Checkmark in short. LLP provides the benefits of a company limited liability, separate legal entity while retaining partnership flexibility. The Act focuses on liability protection, ease of business, and compliance clarity. Would you like me to prepare a concise chart one-page quick revision sheet for this topic perfect for last-minute exam revision startup and its registration? 1. Introduction. A startup is a newly established business that aims to develop a unique product service, scale rapidly, and create jobs and innovation. The Indian government has given statutory recognition and benefits to startups through Department for Promotion of Industry and Internal Trade DPIIT under Startup India initiative launched in 2016. Checkmark purpose. Encourage innovation, create jobs, promote entrepreneurship, ease of doing business. Scroll 2. Startup landscape in India. India is currently the third largest startup ecosystem in the world. As of 2025, there are over 1.1 lakh DPIIT recognized startups. Key sectors. Fintech, EdTech, Agritech, SaaS, Deep Tech, Cleantech, Health Tech. Notable unicorns valuation greater than $1 billion United States dollars. Zomato, Byju's, Paytm, Oyo Rooms, Delivery. Checkmark landmark policy. Startup India Action Plan 2016 Scroll 3. Issue of sweat equity shares by startups. Sweat equity equals shares issued to employees or directors at a discount, or for consideration other than cash for their know-how, intellectual property, or value addition. Right finger regulated by Companies Act, 2013. Section 54 Right finger governed by Companies Share Capital and Debentures Rules, 2014. Checkmark startup benefit. Startups can issue sweat equity shares for up to 50% of paid-up capital in the first 10 years of incorporation versus 25% for normal companies. Scroll 4. Recognition as startups DPIIT. Eligibility. O. Private Limited Company Registered Partnership Firm LLP. O. Entity incorporated is less than or equal to 10 years. O. Annual turnover is less than or equal to 100 crore rupees. O. Working towards innovation improvement of products or processes services. O. Not formed by splitting or reconstructing an existing business. Right finger registration on Startup India portal. Right finger DPIIT issues certificate of recognition. Scroll 5. Certification of the Interministerial Board IMB. Startups recognized by DPIIT can apply to Interministerial Board for tax exemptions under Section 80 IAC of Income Tax Act, 1961. This provides 100% profit exemption for 3 consecutive years out of first 10 years. Eligibility criteria under Section 80 IAC. Must be a company or LLP incorporated after the 1st of April 2016. Must be DPIIT recognized. Turnover is less than or equal to 100 crore rupees. Checkmark exam tip. IMB certification is needed for tax exemption, not just DPIIT recognition. Scroll 6. Tax exemptions. A Section 80 IAC. Tax holiday. 100% deduction of profits for 3 years within 10 years from incorporation. B. Section 56 2 VEB. Angel tax exemption. Exemption from tax on investments above fair market value for DPIIT recognized startups. Encourages angel investments. Scroll 7. Indian states with startup policies. Almost all states have their own startup policy. Top performing states 2021. O. Best performer. Gujarat. O. Top performers. Karnataka, Kerala, Telangana. O. Leaders. Maharashtra, Tamil Nadu, Rajasthan. Right finger based on state startup ranking framework by DPIIT. Scroll 8. State startup ranking. Evolution. 2018. Initial framework launched. 2019. 2021. More states participated. Ranking parameters. Policy support, incubation, funding, ease of business, networking. Scroll 9. Exemptions and benefits for startups under Companies Act, 2013. Exemption from requirement of cash flow statements in financial statements. Exemption from deposit rules Section 73. Exemption from certain board meeting requirements. Longer time for filing returns and compliance. Other benefits. Self-certification under labor and environment laws. Faster patent examination and reduced fees. Easier public procurement norms. Scroll 10. Life cycle of a startup. Stage description, ideation idea generation, market research. Validation MVP minimum viable product, early users. Early traction revenue generation, funding. Scaling expansion, attracting investors. Maturity exit IPO, acquisition, merger, or stabilization. Scroll 11. Registration steps. 1. Incorporate as a private limited company LLP partnership firm. 2. Register on Startup India portal and get DPIIT recognition. 3. Apply for IMB certification for tax benefits optional. 4. Register for GST PAN-TAN if applicable. 5. Comply with labor and environmental self-certification schemes. 6. Avail exemptions and funding opportunities. Checkmark exam tip. Startup India registration is paperless and free. Scroll 12. Important points for a startup. Must innovate or improve a product, process, service. Must not be a mere copy of an existing business. Must not be formed by splitting, reconstruction. Tenure. Valid for 10 years from incorporation date. Scroll 13. Financing options for startups. A seed capital. Initial funding from founders, friends, family, incubators. B. Equity financing. Angel investors, venture capital, private equity. C. Debt financing. Loans from banks, NBFCs, government schemes e.g. Credit. Guarantee fund trust for micro and small enterprises. D. Public offering IPO. Mature startups may go for IPO to raise capital and expand. E. Unconventional financing. Crowdfunding platforms. Revenue-based financing. Convertible notes and safe instruments. Scroll 14. Entrepreneurship. Entrepreneurship involves risk-taking, innovation, and business acumen. Government programs like Atal Innovation Mission and Startup India. Seed fund schemes support entrepreneurs with funding and incubation. Scroll 15. Case studies on unicorn startups. A Zomato. India's first listed unicorn. Founded 2008 by Deepinder Goyal and Pankaj Chadha. Went public in 2021. First Indian unicorn to get listed. Benefited from early-stage VC funding, strong customer base, and regulatory support for digital businesses. Checkmark legal learning point. IPO listing brings compliance under Securities and Exchange Board of India Act, 1992. B. Delhivery. E-commerce logistics platform. Founded 2011. Became unicorn in 2019. Listed on stock exchange in 2022. Focused on tech-enabled logistics and e-commerce fulfillment. Checkmark legal learning point. Expansion funded through equity and debt. IPO required compliance with Companies Act, 2013 and Securities Contracts Regulation Act, 1956. Scroll landmark legal and policy developments. Year policy legislation. 2016 Startup India Action Plan. 2018 Angel Tax Exemption introduced. 2019 IMB certification process simplified. Year policy legislation. 2021 further relaxation in sweat equity and compliance. 2023 DPIIT guidelines revised for tax and compliance benefits. Scroll summary table. Quick revision. Topic: key provisions, bodies, key benefits. Recognition, DPIIT, Startup India Portal official recognition, policy benefits. Tax benefits, Sec 80 IAC and Sec 56 tax holiday, angel tax exemption. Sweat equity, Sec 54, Companies Act up to 50% in 10 years. State ranking, startup ranking framework. Competition and policy improvement, registration online, paperless easy incorporation. Financing, seed, equity, debt, IPO, crowdfunding, multiple funding options. Unicorn case studies. Zomato, Delhivery illustrate growth and compliance. Micro, small and medium enterprises, MSMEs. 1. Regulatory framework. MSMEs in India are primarily governed by the micro, small and Medium Enterprises Development Act, 2006. Objective: to promote, develop, and enhance competitiveness of MSMEs. This act also provides for establishment of authorities and facilitation councils for MSME protection. 2. Introduction. MSMEs play a crucial role in India's economy, contributing approximately 30% to GDP and generating employment. MSMEs operate in both manufacturing and service sectors. They get special policy support, financial aid, and regulatory relaxations. 3. Key provisions of the MSME Development Act, 2006. Lays down classification, registration, benefits, and dispute resolution mechanisms. Establishes National Board for MSMEs to advise the central government. Empowers the government to announce schemes for promotion and development. 4. Important definitions Sec. 2 of the Act. Micro enterprise. O investment is less than or equal to 1 crore rupees. O turnover is less than or equal to 5 crore rupees. Small enterprise. O investment is less than or equal to 10 crore rupees. O turnover is less than or equal to 50 crore rupees. Medium enterprise. O investment is less than or equal to 50 crore rupees. O turnover is less than or equal to 250 crore rupees. As per revised definition effective from July 2020. 5. National Board for MSMEs. Established under Section 3. Headed by the Minister in charge of MSMEs. Advises government on policy matters, development programs, and coordination. 6. Classification of enterprises. Classification based on investment and turnover dual criteria. Enterprises can upgrade or downgrade category based on financial performance. Dynamic system under the UDYM portal allows automatic classification update. 7. Memorandum of MSME and Registration. UDYM registration. UDYM registration replaces old Udyog Aadhaar. Simple online self-declaration with Aadhaar and PAN. No requirement of renewal. Benefits. Easier access to credit, subsidies, tender preferences. 8. Measures for promotion and development. Priority lending through banks. Priority sector lending norms. Subsidies, tax exemptions, technology upgradation support. Market access facilitation through government procurement policies. 9. Benefits of taking UDYM registration. Collateral-free loans. Preference in government tenders. Lower interest rates. Subsidies for ISO certification, patent registration, technology upgrades. Protection against delayed payments. 10. NSIC registration. National Small Industries Corporation. Provides MSMEs access to raw material assistance, marketing support, government tenders without EMD earnest money deposit. Acts as a bridge between MSMEs and larger industries. Government procurement. 11. Major MSME schemes. Scheme objective. Key benefit. PMEGP employment generation subsidy plus loan. Mudra loan micro units funding collateral free loans. CGT MSE credit guarantee for loans. Banks get risk cover. MSE CDP cluster development infrastructure support. SFURTI revival of traditional industries grants plus cluster support. ESDP ATI skill development training grants. PMS marketing trade fairs, promotions. IC scheme international cooperation export promotion. National SCST hub. Promote entrepreneurship in SCST credit and training. Aspire innovation and rural industry incubation support. CGSSD for stressed MSMEs subordinate debt. Shri Fund self-reliant India equity infusion support. 12. MSME Samband. Online portal for monitoring procurement from MSMEs by CPSEs. Central public sector enterprises. Enhances transparency and ensures MSME participation. 13. MSME Facilitation Council. Section 18. Dispute Resolution Forum for delayed payments. Mandatory conciliation before arbitration. Award deemed decree. Directly enforceable. Ensures timely payment within 45 days by buyers. 14. Composition of Facilitation Council. Headed by Director of Industries of the state. Includes MSME representatives and other stakeholders. Council can refer disputes to arbitration under the Arbitration and Conciliation Act, 1996. 15. Landmark case laws. Shriji Sales Corporation vs. Union of India Gujarat HC. O held. MSMEs entitled to protection under the Act and timely payment. Buyers cannot avoid liability. Principal Chief Engineer vs. Manabai and Brothers Sleepers. Private, Limited. Supreme Court. O held. Facilitation Council's award enforceable like a decree. No. Parallel proceedings. Bharat Heavy Electricals Limited vs. Micro and Small Enterprises. Facilitation Council. O held. Arbitration clause in contract does not override statutory mechanism under MSME Act. GET&D India Limited vs. Reliable Engineering Projects and Marketing Delhi HC. O held. MSME Council has exclusive jurisdiction. Parties cannot bypass it by choosing private arbitration. 16. Important rules and regulations to remember. UDYM registration is mandatory to claim MSME benefits. PAN and GSTIN linkage is compulsory for classification. Timely payment clause. Buyers must pay within 45 days. Delay. Attracts compound interest 3 times the RBI bank rate. MSMEs are covered under priority sector lending. Procurement policy. 25% of government purchases from MSMEs, with sub-targets for SC/ST and women entrepreneurs. 17. Quick recap. Definition: limits investment and turnover must be memorized. MSME Act overrides contractual arbitration clauses. Landmark cases revolve around delayed payments and jurisdiction. No major schemes. PMEGP, CGTMSE, SFURTI, Shri Fund. Udyam registration is the entry point for benefits. Facilitation Council awards are binding like court decrees. MSMEs are critical for employment and GDP. Conversion of business entities. 1. Regulatory framework. The conversion of business entities is governed by the Companies Act, 2013 and rules made thereunder. Depending on the type of conversion, e.g. private to public. Depending on the type of conversion, e.g. private to public, public to private, company to LLP, approvals may be required from O Ministry of Corporate Affairs MCA, O Registrar of Companies ROC, O Regional Director Road, O National Company Law Tribunal in specific cases. 2. Introduction. Conversion allows flexibility, scalability, and better compliance. Alignment. It can be voluntary strategic decision or mandatory due to legal provisions. Examples. O private company right pointing arrow public company to raise capital. O LLP right. O private company right pointing arrow public company to raise capital. O LLP right pointing arrow company to scale operations. O company right pointing arrow LLP for operational flexibility. O section 8 company right pointing arrow other company change of object. 3. Conversion of a private company into a public company. Benefits. Access to capital markets IPO. Better visibility and credibility. Easier to raise funds from public. No limit on number of shareholders. Procedure. 1. Convene board meeting right pointing arrow approve conversion proposal. 2. Call general meeting right pointing arrow pass special resolution under section 14(2). Alter articles. 3. File MGT 14 with ROC. 4. Alter memorandum and articles remove restrictions on transfer, members, etc. 5. File INC 27 with required attachments. 6. ROC issues fresh certificate of incorporation. Post-conversion requirements. Update PAN, TAN, bank accounts, statutory registers. Make necessary changes in signage, letterheads, contracts. Comply with public company compliances. 4. Conversion of a public company into a private company. Key points. Section 14 of the Act plus Rule 41 of Companies Incorporation Rules. 2014. Requires approval of Regional Director RD. Procedure. 1. Board resolution right pointing arrow proposal to convert. 2. Special resolution in general meeting. 3. Alteration of articles to include restrictions. 4. File MGT 14. 5. Apply to road and form RD1 within 60 days. 6. Serve notices to creditors, ROC, road. 7. After approval, ROC issues new certificate of incorporation. Post-conversion. Update statutory records. Modify company name adding private limited. Comply with private company norms, no need of minimum 3 directors, can reduce number of members, etc. 5. Conversion of Section 8 company into other kind of company. Section 8 companies are formed for charitable or non-profit purposes. Conversion requires approval of the regional director. Procedure. 1. Board and special resolution. 2. Application to road and form INC 18. 3. Publish notice in newspapers. 4. Obtain NOC from authorities IT, charity commissioner, etc. 5. On approval, file INC 20 for conversion. 6. ROC issues certificate of incorporation. 6. Conversion of company into LLP. Governed by Limited Liability Partnership Act, 2008. Popular for lower compliance burden and tax efficiency. Procedure. 1. Consent of shareholders and creditors. 2. Board resolution for conversion. 3. Apply in Form Philip and Form 18 to ROC. 4. Statement of assets and liabilities. 5. Approval right pointing arrow LLP certificate of incorporation issued. 6. Transfer assets, liabilities, and licenses to LLP. 7. Conversion of LLP into company. LLP may convert to private company under Section 366 of the Companies Act Part 21. Procedure. 1. Partners consent and board resolution. 2. Name approval run service. 3. File URC1 with supporting documents. 4. Publish advertisement in newspaper. 5. Obtain NOC from creditors. 6. ROC issues COI after scrutiny. 8. Conversion of one-person company OPC. A OPC to private public company. Mandatory if turnover greater than 2 crore rupees or paid up capital greater than 50 lakh rupees. Procedure. 1. File INC 5 intimation of exceeding limit. 2. Board resolution plus alter MOA and AOA. 3. Increase number of directors and members. 4. File INC 6 for conversion. 5. ROC issues fresh COI. B private company to OPC. Allowed under Section 18 and Rule 7 of OPC rules. Procedure. 1. Board resolution and shareholder approval. 2. Ensure paid up capital is less than or equal to 50 lakh rupees and turnover is less than or equal to 2 crore rupees. 3. Obtain NOC from creditors. 4. File INC 6. 5. ROC issues certificate of incorporation as OPC. 9. Companies authorized to register under Part 21 of the Act. Section 366 of the Companies Act covers registration of OLLPs, O partnership firms, O societies, O cooperative societies, O any other business entity formed under any other law. These entities can register as companies limited by shares or guarantee. 10. Effect of registration under Part 21. Entity becomes a company under Companies Act. All assets, liabilities, rights, privileges automatically vest in the company. Existing contracts remain valid. Members become shareholders. 11. Essential preconditions for registration under Part 21. Consent of majority partners members. Proper books of accounts. Advertisement in newspaper for public notice. Minimum 2 directors for private, 3 directors for public. Digital signatures, DIN, and name approval. 12. Important legal provisions and points. Section 14. Alteration of articles for conversion. Section 18. Conversion of existing company into another class. Section 366. Registration of entities under Part 21. Forms commonly used. MGT 14, INC 27, RD 1, INC 18, INC 20. Philip, Form 18, URC 1, INC 6. 13. Landmark case laws. Sandvik Asia Limited vs. Bharat Kumar Padamji, O held. Conversion of company requires genuine intent and proper compliance with procedure. Madhusudan Gordhandas and Company vs. Madhu Woolen Industries, Private, Limited. O held. Court will not interfere in genuine corporate restructuring unless fraudulent. Re. Madras Gymkhana Club, O held. Section 366 covers conversion of societies and clubs into companies. Perlite Liners Private, Limited vs. Manorama Sursi, O held. Alteration of articles for conversion must comply with statutory procedure strictly. 14. Quick recap. Section 14. Alteration of articles private left right arrow public. Section 18. Conversion of existing company into other type. Section 366. Registration of LLP, firm, society under Companies Act. OPC conversion thresholds. 50 lakh rupees paid up capital 2 crore rupees. Turnover. Road approval needed for public right pointing arrow private conversion. Section 8 conversion requires road plus newspaper publication. LLP left right arrow company conversions involve URC 1 and Philip INC forms. Non-corporate entities. 1. Regulatory framework. Non-corporate entities are governed primarily by O Indian Partnership Act, 1932. O Income Tax Act, 1961. O Hindu Succession Act, 1956 for HUF. O Multi-State Cooperative Societies Act, 2002. O Indian Trusts Act, 1882. O Societies Registration Act, 1860. These entities do not have a separate legal personality like companies or LLPs except some specific forms like registered societies or trusts. Common types. O Partnership Firms. O Hindu Undivided Family HUF. O Sole Proprietorship. O Multi-State Cooperative Society. O Trust. O Society. O Mega Firm Large Partnership Consortium Model. 2. Introduction. Non-corporate entities are simpler, involve fewer compliances, and are widely used in India for small and medium businesses. They allow flexible management and taxation benefits in some cases. However, they usually lack limited liability protection. 3. Partnership. Definition. Section 4 of the Partnership Act. Partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Features. Minimum 2 partners, max 50 as per Companies Act for business. Mutual agency. Profit loss sharing. No separate legal entity. Unlimited liability. Types of partnership. 1. General partnership. All partners have unlimited liability. 2. Partnership at will. Can be dissolved at any time. 3. Particular partnership. For a specific venture or time. Types of partners. Active, sleeping, nominal, minor admitted to benefits only. Partner by estoppel or holding out. 4. Minor admitted to benefits of partnership. Under Section 30, a minor cannot be a full partner but can share in profits and have rights to access accounts. On attaining majority, the minor must elect to continue or not. 5. Merits and limitations of partnership. Merits. Easy formation, better decision-making collective, risk sharing, tax benefits, limitations. Unlimited liability, limited capital, lack of continuity, mutual agency risk. 6. Partnership deed, a written agreement between partners specifying terms. Contains O firm name, business nature. O capital contribution, O profit sharing ratio, O rights and duties of partners. O dispute resolution, benefits, reduces disputes, legal clarity, admissible as evidence. 7. Registration procedure of partnership. 1. Application to Registrar of Firms. 2. Submit Form I, partnership deed, and fee. 3. Registrar enters details in the Register of Firms. 4. Issue of registration certificate. Consequences of non-registration. Firm cannot sue third parties. Cannot enforce contractual rights in court. Third parties can sue the firm. 8. Registration under income tax. Firm must obtain PAN. File returns as a partnership firm. Deduction of remuneration and interest to partners subject to Section 40B of the IT Act. 9. Hindu Undivided Family HUF. Meaning, a HUF is a family business managed by Karta and co-partners. Governed by Hindu law and income tax provisions. Characteristics. Formed by family status, not contract. Headed by Karta. Co-partners have birthright, equal rights to property. Benefits. Tax advantages separate PAN. Succession within family. Simple structure. Limitations. Restricted to Hindu families. Disputes may arise. Limited business scope. Formation of HUF. 1. Form a family unit. 2. Create capital ancestral or gift. 3. Apply for PAN in name of HUF. 4. Open bank account. 10. Sole proprietorship, single individual owns and manages business. Not a separate legal entity. Merits. Easy formation, full control, quick decision making. Limitations. Unlimited liability, limited capital, business ends with owner's death. Formation procedure. Choose business name. Register under Shops and Establishment Act if required. Obtain PAN and GST registration if applicable. Open bank account. 11. Multi-State Cooperative Society. Registered under Multi-State Cooperative Societies Act, 2002. Operates in more than one state. Member-owned and democratically controlled. Benefits. Economies of scale. Government support. Tax benefits. Formation procedure. 1. Minimum 50 members from at least 2 states. 2. Application with bylaws. 3. Registrar approval. 4. Certificate of registration issued. 12. Trust. Governed by Indian Trusts Act, 1882 for private trusts. Public trusts governed by state laws. Objectives. Charitable, religious, educational, or private benefits. Who can create? Any competent person with legal capacity. Who can be trustee? Any individual capable of holding property. Public versus private trust. Public. Benefits the public at large. Private. Benefits identified individuals. Exemptions. Charitable trusts get tax exemptions under Sections 11 and 12 of IT Act. Private trusts tax differently. Formation. 1. Draft trust deed. 2. Stamp duty payment. 3. Registration with sub-registrar. 4. PAN application. 13. Society. Governed by the Societies Registration Act, 1860. Used for NGOs, charitable, cultural and literary activities. Advantages. Simple registration. No minimum capital requirement. Tax exemptions. Disadvantages. No profit distribution. Strict compliance. Formation. 1. Minimum 7 members. 2. Select unique name. 3. Draft MOA and rules and regulations. 4. File with Registrar of Societies. 5. Certificate of registration issued. MOA includes name, objects, details of members. Consequences of registration. Legal recognition, can hold property, sue and be sued. 14. Accounts and audits of society. Maintain regular accounts. Annual audit required. Filing of annual returns with registrar. Litigation. Society can file or face suits in its own name. 15. Mega firm. Large partnership or consortium of firms formed for a specific project or objective. Prerequisites. Multiple partners entities. Legal agreement defining scope, common capital and management. Benefits. Combined expertise. Larger capital base. Competitive edge in large projects. Process of constitution. 1. Draft agreement between firms. 2. Define roles, contributions, profit share. 3. Register if required. 4. Obtain PAN and tax registrations. Risks. Unlimited liability. Disputes among partners. Governance complexity. 16. Important legal provisions. Section 4. Definition of partnership. Section 30. Minor admitted to benefits. Section 69. Consequences of non-registration. Income Tax Act. Section 40B on partners' remuneration. Indian Trusts Act, 1882. Societies Registration Act, 1860. 17. Landmark case laws. Cox vs. Hickman 1860. O principle. Existence of partnership depends on mutual agency, not just profit sharing. Champaran Kane Concern vs. State of Bihar. O held. Unregistered firm cannot sue third parties. Rashik Lal and Company vs. CIT 1998. O held. Remuneration to partners is business income, not salary. Lachman Das vs. CIT 1948. O held. HUF is a separate taxable entity. Narendra Doshi vs. CIT. O held. Carta represents HUF in tax and legal matters. 18. Quick revision pointers. Partnership. Sec 4. 69. Unlimited liability. Registration not mandatory, but advisable. HUF. Formed by status, not contract. Headed by Carta. Sole proprietorship. Simple structure, no separate legal entity. Trust. Created through trust deed, gets tax exemptions if charitable. Society. Minimum 7 members, governed by Societies Act, for nonprofit activities. Mega firm. Collaborative large partnership. Non-corporate entities equals less compliance plus more personal liability. Business collaborations. 1. Regulatory framework. Business collaboration refers to agreements between 2 or more entities to cooperate in business activities to achieve mutual benefits. It can be domestic or international. It may involve technology transfer, resource sharing, FDI, or market expansion. Key regulations. Companies Act, 2013. Foreign Exchange Management Act, 1999 FEMA. Foreign Direct Investment Policy of India FDI Policy. Competition Act, 2002. Indian Contract Act, 1872. 2. Foreign collaboration. Pushpin meaning, association between an Indian entity and a foreign entity for technology, know-how, patent, brand, or capital investment. Can be technical, financial, or managerial. Pushpin examples. Technology transfer from a foreign company. Licensing and franchising e.g. McDonald's in India. Foreign equity participation. Pushpin features. Involves cross-border contracts. Brings advanced technology and funds. Increases competitiveness of Indian firms. Subject to FEMA and FDI regulations. Pushpin objectives. Access to foreign capital. Technology upgradation. Boost exports and employment. Global market entry. Pushpin important regulations. FDI policy and FEMA rules. Department for Promotion of Industry and Internal Trade DPIIT. Approval for restricted sectors. Automatic versus government approval routes. Sectoral caps e.g. Defense 74% automatic. Pushpin landmark case. McDonald's India JV dispute McDonald's versus Vikram Bakshi. Issue. Termination of JV agreement and oppression of minority partner. Held. NCLAT protected minority partners' rights and emphasized good faith in JVs. 3. Joint venture JV. Pushpin meaning, a contractual or equity arrangement where two or more parties form a new entity or partnership for a specific business objective. Common in infrastructure, automobiles, telecom, pharma, etc. Pushpin definition. As per FDI policy, JV is a business entity formed by two or more parties with shared ownership and control. Pushpin advantages. Shared risk and cost. Access to local market knowledge and infrastructure. Resource and technology sharing. Faster business expansion. Pushpin disadvantages. Cultural differences. Conflict of interest. Control and decision-making issues. Regulatory complexities. Pushpin strategies for entering JV. Equity participation. Technical collaboration. Licensing. Franchising. Strategic alliances. Pushpin formation. Memorandum of Understanding MO. Shareholders Agreement Joint Venture Agreement. Incorporation of JV Company. Approvals if FDI involved. Compliance with Companies Act and FEMA. Pushpin important rules and regulations. Companies Act, FEMA, FDI policy. Competition Act, 2002. To prevent anti-competitive agreements. Reserve Bank of India approval where required. Pushpin landmark case. Tata Docomo arbitration case. Issue. Enforcement of put option clause in JV with foreign investor. Held. Enforceable under arbitration. India must respect contractual obligations under FDI. 4. Special Purpose Vehicle SPV. Pushpin meaning, a legally separate entity created for a specific project or purpose. Often used in infrastructure projects and fundraising. Protects parent company from financial risk. Pushpin benefits. Easy fundraising. Limited liability. Regulatory flexibility. Facilitates large infrastructure or PPP projects. Pushpin purpose. Housing specific assets and liabilities. Risk isolation. Tax benefits. Pushpin difference between SPV and company. SPV regular company. Project specific general business. Risk isolated risk shared. Easier compliance in PPP broader compliance. Pushpin establishment. Incorporation is a private limited company, LLP, or trust. Drafting MOA and AOA with limited scope. Project specific bank accounts and contracts. Pushpin key regulations. Companies Act, 2013. FEMA for Foreign Funding Securities and Exchange Board of India issue of capital N. Disclosure Requirements Regulations, 2018 if raising funds through capital markets. PPP Guidelines by Niti Aayog. Pushpin landmark case. Delhi Airport Metro Express Private Limited versus Delhi Metro Rail Corporation SPV dispute. Issue. Concession agreement termination and compensation. Held. SPV entitled to compensation as per contract. Reinforces sanctity of PPP agreements. 5. LLP firm is SPV. LLPs can be used as SPVs for flexible structure and lower compliance cost. Useful in real estate, infrastructure, renewable energy. Must comply with Limited Liability Partnership Act, 2008. Setting up of branch office BO liaison office LO. Project office PO wholly owned subsidiary WOS by Foreign Company. 1. Regulatory framework. Governed mainly by O Foreign Exchange Management Act, 1999 FEMA. O Companies Act, 2013. O Reserve Bank of India RBI. Master Directions on BO LOPO. O Ministry of Corporate Affairs MCA. Entry options for foreign companies in India. 1. Branch office BO. 2. Liaison office LO. 3. Project office PO. 4. Wholly owned subsidiary WOS. 2. Important terms. BO branch office. Extension of a foreign company carrying on business activities in India, not a separate legal entity. LO liaison office. A representative office to promote business without undertaking commercial activity. PO project office. Temporary office to execute a specific project. In India. WOS wholly owned subsidiary. An Indian company, incorporated under Companies Act with 100% foreign ownership. 3. Key provisions. Foreign companies must comply with FEMA and FDI policy. Approval route. O automatic route. If foreign entity is an eligible sector with required net worth. O government route. If from restricted countries sectors. RBI issues approvals. Registrar of Companies registration is mandatory. 4. Provisions pertaining to name. Name of BO PO must be the same as parent foreign company. WOS must follow normal company name approval procedure under Companies Incorporation Rules, 2014. 5. Branch office BO. Pushpin eligibility. Profit making track record in home country for 5 years. Minimum net worth of 100,000 United States dollars or equivalent. Pushpin permitted activities. Export import of goods. Consultancy services. Research work. Professional or technical services. Representing parent company in India. Acting as buying selling agent. IT services and software development. Pushpin registration. RBI approval through authorized dealer bank AD category I. Registration with MCA via MCA 21. PAN, TAN, GST registration is applicable. Pushpin funding. BO must be funded by parent company through inward remittance. 6. Liaison office LO. Pushpin eligibility. Profit making track record in home country for 3 years. Minimum net worth of 50,000 United States dollars or equivalent. Pushpin permitted activities. Promotion of parent company business. Communication channel between parent and Indian parties. No commercial activities or income generation allowed. Pushpin extension of validity. Initial approval. 3 years. Can be extended by RBI if conditions are met. 7. Project Office PO. Pushpin parameters. Established for executing specific projects in India. Automatic route allowed if project is funded by inward remittance or international funding agency. Pushpin RBI approval required when parent entity is from a country sharing land border with India. Sector is restricted or sensitive. Funding source does not meet automatic route norms. 8. Master Direction RBI. RBI issues consolidated instructions under foreign exchange. Management establishment in India of a branch office or liaison office or a project office or any other place of business regulations 2016. Authorized dealer banks process most applications. 9. Procedure for establishment of BO-LOPO. 1. Application to RBI through AD Category I Bank Form FNC. 2. RBI AD Bank Approval. 3. Registration with MCA Form FC1. 4. PAN-TAN, GST, Bank Account. 5. Annual filings. 10. Bank account opening. Separate bank account required for each office BO-LOPO. Inward remittance from parent company only. 11. Annual Activity Certificate AAC. Mandatory filing by BO-LOPO. Certified by a chartered accountant. Submitted to RBI and AD Bank within 6 months of financial year end. 12. Extension of validity. LOPO approvals may be extended on application with proper justification. BO generally has no fixed validity period. 13. Registration with police authorities. Mandatory for entities from countries sharing land border with India. E.g., China, Pakistan. Reporting to Ministry of Home Affairs MHA. 14. Additional offices and activities. Requires prior RBI approval. Activities must be consistent with original approval. 15. Extension of fund and non-fund based facilities. BO can avail fund non-fund based facilities from banks after RBI approval. LOPO usually restricted. 16. Remittance of profit surplus. BO and PO can remit profits net of taxes to parent company. LO cannot remit surplus as no commercial activity is allowed. 17. Closure of BO-PO-LO. Pushpin conditions. All liabilities cleared. No pending litigation. Intimation to AD Bank, RBI and MCA. PAN cancellation, GST deregistration. Scroll landmark cases. INRAE, Nokia Solutions and Networks India Private Limited, 2014. Issue. BO vs. WO structure and tax liability. Held. BO cannot engage in income generating activities. Tax applicable only to permitted operations. DIT vs. Morgan Stanley and Company. 2007 SC. Issue. Permanent establishment PE and taxation of foreign company branch in India. Held. BO constitutes PE. Profits attributable to India taxable here. Formula 1 World Championship Limited. VS CIT 2017 SC. Issue. Fixed place PE. Held. Even temporary presence e.g. F1 circuit can constitute PE in India. Setting up of business outside India and related issues. Exam. Notes. 1. Regulatory framework. Governed primarily by O Foreign Exchange Management Act, 1999 FEMA. Specifically Overseas Investment OI Regulations Rules. O Companies Act, 2013. For Indian entities making overseas investments. ORBI Master Directions on Overseas Investments. O Foreign Direct Investment Policy of India. Goal. Enable Indian companies to invest abroad while ensuring regulatory control and compliance with FEMA. 2. Key concepts. Pushpin evolution. Overseas investment by Indian companies allowed post-liberalization 1991 onwards. Regulations updated periodically to align with global practices and 2. Ease of doing business. Pushpin investments and developments. Indian entities can invest in subsidiaries, joint ventures, equity, shares, and project financing abroad. Sectors. IT, Pharma, Telecom, Manufacturing, and Services. Pushpin laws authorities. FEMA 1999. Overseas Investment Regulations OI Rules and OI Regulations. RBI. Issues approvals and monitors reporting. Automatic route versus approval route for foreign investments. Ministry of Finance Department of Economic Affairs. For no objection certificate NOC in certain cases. 3. OI Rules versus OI Regulations. Feature OI Rules OI Regulations. Year introduced 2003-2017 onwards. Focus consolidated approval route for overseas investment. Streamlined reporting and regulatory compliance. Applicability Indian companies investing abroad Indian companies and LLPs. 4. Overseas investment. Pushpin eligibility. Indian entities include O Companies Incorporated under Companies Act, 2013. O LLPs under LLP Act, 2008. O Resident Individuals under FEMA specific cases. Pushpin non-applicability. Partnerships, sole proprietorships, trusts unless registered as Indian entity. Pushpin prohibitions. Investments in prohibited countries or sectors restricted under FDI policy or RBI directions. Speculative investments, gambling, or unapproved real estate. Pushpin routes. Automatic route. Approved sectors. No RBI prior approval. Required. Approval route. RBI government approval needed. Requires. Submission of Form ODI, board shareholder approval, and sector clearance. Pushpin no objection certificate NOC. Required from certain authorities for government-related sectors. E.g. defense, banking, insurance. Pushpin method of funding. Out of own funds, loans from Indian banks with RBI approval, or internal accruals. Remittance must follow RBI prescribed limits and reporting. 5. Reporting requirements. Form ODI. Submission to AD Bank authorized dealer. Annual returns and compliance under FEMA Section 63, 64. RBI tracks funds remitted, shares issued, and profit repatriation. 6. Issues in choosing location outside India. Regulatory environment. Ease of doing business. Tax treaties and double taxation avoidance agreements DTAA. Political stability. Market size and infrastructure. Currency risk and repatriation of profits. Country-specific business setup. 1. New Zealand. Business environment. Ranked first in World Bank Ease of Doing Business 2020 in starting a business. Stable political and legal framework. Transparent corporate laws. Companies Act 1993. Key features for Indian investors. Low corporate tax. 28%. Quick incorporation. 1. 2 days online. No restriction on foreign ownership. Strong IP protection and labor laws. Business reforms. Electronic filing of company registration. Simplified tax system for foreign-owned companies. Investor-friendly reforms. Ease in obtaining building permits. Contracts enforcement. Challenges. Small domestic market. Export-oriented strategy advisable. Geographically distant. Logistic costs for physical business. 2. Singapore. Business environment. Ranked second globally in WB Ease of Doing Business 2020. Excellent infrastructure. Strategic location for SE Asia markets. Key features for Indian investors. Corporate tax. 17%. Various incentives for startups and SMEs. 100% foreign ownership allowed for most sectors. Strong IP, legal, and regulatory protection. Attractive for financial services, logistics, and healthcare. Initiatives and reforms. Smart nation initiatives, digital-first processes. Startups. Tax exemptions for first 3 years. Simplified incorporation via ACRA accounting and corporate. Regulatory authority. Challenges. High cost of living and office space. Stringent labor laws for foreign hiring. 3. Hong Kong SAR, China. Business environment. Free market economy with minimal corporate restrictions. Ranked high in WB Ease of Doing Business 2020. Key features for Indian investors. Simple tax structure. Corporate tax 16.5%, no GST. 100% foreign ownership permitted. Minimal restrictions on repatriation of profits. Strategic gateway to China and Asia Pacific. Business reforms. Streamlined online incorporation. Investor-friendly banking and finance system. Flexible office setup rules and low compliance requirements. Challenges. Political uncertainties in recent years. Competition with mainland Chinese enterprises. 4. United States. New York City. Business environment. Largest economy. Strong legal and financial infrastructure. Access to capital markets via SEC regulations. Key features for Indian investors. State-specific corporate tax NYC plus NY state combined. Approximately 26%. Incorporation options. C Corp, LLC, LLP. Well-developed banking and funding ecosystem. Strong IP protection and contract enforcement. Business reforms. One-stop state registration portals. Transparent labor and corporate laws. E-signature and digital compliance allowed. Challenges. Complex tax compliance. Federal plus state plus local. Highly competitive market. 5. United Kingdom. Business environment. Ranked 8th globally in WB Ease of Doing Business 2020. Common law system. Familiar to Indian companies. Key features for Indian investors. Corporate tax. 19% planned 25% from 2023. Simple incorporation process via Companies House. No restriction on foreign ownership. Financial incentives for SMEs and tech startups. Business reforms. Brexit-related reforms. New trade agreements and regulatory clarity. Digital submission of documents. Online company registration. Business-friendly tax treaties with India. Challenges. Currency fluctuation GBP. Post-Brexit regulations require careful compliance. 6. Canada. Business environment. Stable economy, strong IP and labor laws. Multiple federal and provincial incentives for foreign investors. Key features for Indian investors. Corporate tax. Approximately 15% federal plus provincial tax range is 11.16%. Full foreign ownership allowed. Highly skilled workforce and infrastructure. Business reforms. Simplified incorporation through Canada Business Corporations. Act CBCA. E-filing available for federal and provincial companies. Grants and incentives for R&D and technology. Challenges. Complex immigration rules for expatriate employees. Regional differences in provincial laws and taxes. 7. Australia. Business environment. Stable political and economic environment. Ranked 14th globally in WB Ease of Doing Business 2020. Key features for Indian investors. Corporate tax. 30%, reduced rates for SMEs. Full foreign ownership allowed. Ease of setting up branches or subsidiaries. Strong IP, legal, and regulatory framework. Business reforms. Online company registration via ASIC Australian Securities and Investments Commission. Government incentives for infrastructure, technology, and renewable energy. Challenges. High living and operating costs. Regulatory compliance can be complex across states. 9. Landmark references cases. Morgan Stanley India vs. DIT 2007 SC. Tax liability of overseas investments by Indian entities. Nokia Solutions and Networks vs. Indian Authorities 2014. ODI. Reporting compliance. Formula One World Championship Limited. South Carolina 2017. Overseas PE. And repatriation of profits considerations identifying laws applicable to various industries and initial compliance. 1. Introduction. Before setting up any enterprise, compliance with industry-specific laws is mandatory. Legal framework includes Companies Act 2013, FEMA, labor laws, taxation laws, IP laws, sectoral laws. Choosing correct business structure is crucial for liability, tax, and regulatory compliance. 2. Formalizing and deciding business structure. Major business structures in India. 1. Private limited company. Separate legal entity, limited. Liability, minimum 2 directors. 2. Public limited company. Can raise public funds, stricter. Compliance. 3. One-person company OPC. Single promoter, limited. Liability. 4. Limited liability partnership LLP. Hybrid between partnership and company. 5. Section 8 company. Nonprofit for promotion of commerce, science, or arts. 6. Sole proprietorship partnership HUF. Simple, but unlimited liability. 3. Section 8 company. Eligibility. O objects must promote commerce, art, science, charity, education, environment. O profits must be used only for objectives, not for distribution. Compliance. O license from MCA Form INC 12. O articles of association with mandatory clauses. Landmark case. O Tech Mahindra Foundation vs MCA 2016. Court upheld that Section 8 companies must strictly follow nonprofit objectives. 4. Formation of a company. Steps. 1. Obtain digital signature DSC for directors. 2. Apply for director identification number DIN. 3. Name approval run SPICE Plus. 4. Filing incorporation form SPICE Plus. Includes MOA and AOA. 5. Obtain PAN and TAN. Documents. MOA, AOA, proof of registered office, ID and address proofs. Of directors. 5. Applying for business licenses, depending on industry. O Shops and Establishment Act registration. O GST registration. O FSSAI license. For food business. O drug license. For pharma. O Pollution Control Board clearance. For manufacturing. O sectoral approvals. NBFC, banking, insurance, telecom, real estate. 6. Taxation and accounting laws. Income Tax Act 1961. Registration and compliance. GST Act 2017. Applicable for goods services. Companies Act 2013. Annual financial statements, board reports. Accounting standards. IND-AS compliance. Landmark case. CIT vs. Reliance Industries Limited. 2013. Importance of accurate books of accounts and disclosure of offshore transactions. 7. Labor laws compliance. Applicable to all employees. O Factories Act 1948. Manufacturing units. O Payment of Gratuity Act 1972. O Employees Provident Fund and MISC. Provisions Act 1952. O Employees State Insurance Act 1948. O Minimum Wages Act 1948. Compliance. Registration, maintenance of records, periodic filings. Landmark case. Workman of Maruti Suzuki vs. Management 2013 SC. Employer, liable for non-compliance of labor rights even if outsourced. 8. Intellectual property IP laws. Protects trademarks, patents, copyrights, designs, trade secrets. Compliance. Registration with Controller General of Patents, Designs and Trademarks. Landmark case. O Novartis AG vs. Union of India 2013 SC. Clarified. Patentability and public interest in pharma. 9. Contract management. Indian Contract Act 1872. Key compliance at the time of business. Setup. Ensures enforceability of agreements with suppliers, customers, employees. Landmark case. Larsen and Toubro Limited. vs. State of Karnataka 2009. Contract. Clarity and enforceability. 10. Industry-specific laws. Industry key laws and compliance. Trading and Retail GST, Shops and Establishment Act, FSSAI of Food, Consumer Protection Act. IFSC and Bullion Exchange. SEBI regulations, RBI circulars, income tax, KYC-AML norms. Startup recognition, Section 80 IAC income tax, Companies Act compliance. NBFC RBI registration, FEMA, KYC-AML, minimum net owned fund. Pharma Drugs and Cosmetics Act, FDA approvals, GMP compliance. Banking RBI license, Banking Regulation Act, FEMA, anti-money laundering laws. Insurance URDI registration, Insurance Act 1938, solvency and reserve compliance. Housing Finance National Housing Bank NHB registration, FEMA compliance. Real Estate RERA registration, environment clearance, land acquisition laws. Telecom TRI license, spectrum allocation, radiation and safety norms. IT Software Companies Act, income tax, labor laws, software industry key laws and compliance. IP registration, media and communication, Ministry of Information and Broadcasting licenses, Copyright Act. Infrastructure Environment clearance, labor laws, Contract Act compliance. Environment Law Air and Water Acts, EIA approval. Pollution Control Board compliance various initial registrations and licenses. 1. Regulatory framework. Businesses in India require registrations and licenses for O legal recognition, O tax compliance, O labor law adherence, O environmental compliance, O sector-specific approvals, key laws authorities, O Companies Act, 2013 LLP Act, 2008. MCA, O Income Tax Act, 1961. PAN-TAN, Income Tax Department. O GST Act, 2017. GST Network, CBIC. O Labor Laws. EPF ESI State Labor Departments. O Environment Laws. CPCB SPCB. O Sectoral Laws. RBI, URDI, FSSAI, DGFT, TRI. 2. Introduction. Registration ensures legal recognition and compliance. Non-compliance leads to fines, penalties, prosecution, or suspension of business operations. 3. Business entity registration. Types. Private limited, public limited, OPC, LLP, partnership, sole proprietorship, authority. ROC MCA documents. MOA, AOA, LLP Agreement, PAN, DIN, DSC, Office Proof. Penalties. Company cannot sue, ROC may fine under Companies Act, Sec 12. 14. Landmark Case. ACC Bank Limited. VSMCA 2010. Registration under Companies Act is mandatory. Unregistered entities cannot claim corporate benefits. 4. Mandatory registrations. 4.1 PAN, 10-digit ID for taxation, banking, and investments. Penalty. 10,000 rupees under Sec 272 BIT Act for misuse non-filing. Landmark Case. CIT vs Reliance Industries Limited. 2013. PAN, mandatory for all financial transactions. Ensures tax accountability. 4.2 TAN, required for TDS-TCS compliance. Penalty. 10,000 rupees under Sec 272 BIT Act for failure to obtain TAN. Landmark Case. CIT vs Indian Oil Corp. 2012. TAN is essential for remitting TDS. Non-compliance attracts penalties. 4.3 GST registration. Unified indirect tax. Threshold. 40 rupees L goods 20 rupees L special states. Authorities. GSTN, CBIC. Penalties. Section 122. Late registration. 10% of tax or 10,000 rupees. Whichever lower. Landmark Case. Mohit Minerals Private, Limited vs State of Maharashtra. 2019. Eligibility for GST composition scheme clarified. Only small taxpayers can opt. 4.4 Shops and Establishments Registration. Regulates working conditions, wages, holidays. Authority. State Labor Department. Penalty. Fines 500 rupees. 5,000 rupees varies by state. Landmark Case. Workmen of Maruti Suzuki vs Management 2013. SC. Employers liable for labor law compliance. Registration ensures employee rights. 5. Labor law registrations. 5.1 ESI. Applies to 10 plus employees 20 plus in some states. Authority. ESIC. Penalty. Section 85. Fine imprisonment for non-compliance. Landmark Case. ESIC vs Alembic Pharmaceuticals 2012. ESI. Coverage applies even if employment is contractual. Employers must register all eligible employees. 5.2 EPF. Applies to 20 plus employees. Employer and employee contribute 12% each. Authority. EPFO. Penalty. Sec 14B. Fines and interest for late contribution. Landmark Case. EPF Appellate Tribunal vs XYZ Private. Limited. 2015. Employers liable for EPF contribution even for past periods. Ensures employee retirement benefits. 6. Pollution Control and Environment Compliance. Applies to industrial manufacturing units. Authorities. CPCB SPCB. Procedure. NOC, EIA if applicable. Penalties. Sec 15. 16 EPA 1986. Fine 1 lakh rupees, imprisonment up to 5 years for pollution. Landmark Case. MC Mehta vs Union of India 1987. Supreme Court. Mandated strict compliance with pollution norms, especially industries affecting rivers Ganga. Set precedent for environmental liability. 7. Other sector-specific registrations. Sector activity. Registration. License authority penalty notes Landmark Case. Import-Export IECD GFT penalty 25,000 rupees for non-compliance. Pharma Drug License. Central State Licensing Authority. Fine imprisonment for unlicensed sale. Novartis AG vs Union of India 2013. Pharma licenses plus patent compliance mandatory. Food. FSSAI registration license. FSSAI. Fine 25,000 rupees. 1 lakh rupees. Imprisonment 6 months. 2 years. FSSAI vs Food Startups. Mandatory registration for all food businesses. NBFC RBI registration RBI. Penalties under RBI Act. License suspension. ACC Bank Limited. VS RBI 2010. NBFC operations require RBI license. Banking RBI license RBI heavy fines, license sector activity. Registration. License authority penalty notes Landmark Case. Cancellation. Insurance ERDI. Registration ERDI license suspension cancellation. Telecom OSPISP license. Tri-service suspension fine. State industrial approval. State industrial department. State fines for non-compliance.